Welcome to the Hog Market Talk podcast, your weekly deep dive into hog market fundamentals, breaking news, and industry insights. Trading commodity futures and options involves substantial risk of loss and is not suitable for all investors.
This is Mike Miner. How's it going, Luke?
It's going good, sir. We got beautiful weather here today. What is it outside? It's
like going to be 80 tomorrow.
Smoking nice. We'll take it.
Only like 100-degree change in the last few days.
We deserve it from last week. And last Sunday was a blizzard.
Yeah.
There wasn't very many pork chops getting grilled last Sunday, but hopefully they're out in numbers this weekend, huh?
We're going to do our best to help out demand this weekend. Speaking of that, this is a Hog Market Talk podcast, so let's talk about the hog market here a little bit. Luke, you want to just start with a little bit of the pullback we've had here recently?
Yeah, for sure. I want to talk about hogs, but then I want to talk about this just to put it in front of the Iran conflict and how it relates to energy, oil, and corn prices, right?
Certainly.
So, hereby, we did have a rougher week in the lean hog complex. We kind of were losers all across the spectrum, more up front in the summer, and the deferreds held in just a little bit better. But yeah, a few things I'd like to talk about. We got to remember this is March 20th, okay? Mm-hmm. And I think we'll have Cade pull up a few graphs here, and we'll start with the CME index. And when you look at the CME index and you look at the trend here through April expiration, awaiting into our spring rally, it is a flatter trend, right? It's just when you look at that, it's hard to see a lot of years that can really get a long ways over 90. Blow that up a little bit, Cade, and we'll highlight that a little bit better. And so that's a flatter trend. That's the backdrop. Then take a look at cutout, and we'll go just straight into the cutout side. And again, cutout, we've got a 98. It's bounced around 100, but you look at the trend too. Cutout's kind of flat here. It's just normal. And cash also, you don't need to bring the chart up, Cage, but it's a flatter type. And we still have a fair heavy production runs, not burdensome, right? But that's a flatter tone. And then specifically, on the cutout, let's look at the belly chart. If you look at the belly chart, bellies have been punching above their weight, and that's really good stuff, Mike, right? But this time of year, it's hard to get bullish bellies from that level. So probably a little softer is a little easier path of resistance, right? But hard to get bullish to think that that's going to proper primal up here short term, right? And then the hams. There's been a lot of talk around hams this week, and hams went sub 80, and we broke. They didn't quite hold that support. And again, I don't want to cause huge alarm bells here, but look at the ham, maybe bring your cursor away, Cade, just so we can see the 5-year average. It's a rough time for the ham trade just here seasonally till we get into a little light production runs. And we're hearing a little softness out of Mexico, kind of the meat traders saying maybe hams aren't just, they're not ready to turn and go higher yet. So you kind of throw all that, and we took the index up to 92, took it back here just a little bit. We just had a little too much premium in. Also we'll go back, we'll talk around the Iran conflict, and in our opinion, some things that changed there this week we need to be mindful of. But the futures just pulled back some premium, a little bit of risk off, a little bit of technical selling. Also next week is the Hog and Pig report, March Hog and Pig report. Private estimates came out yesterday during the trade, kind of when we had this sell-off, and I'm not going to say I agree or disagree. Well, maybe I will, but they came up with some higher inventories, like 1% to 2% more pigs, and so I just think all that kind of bowed into all that, and we had ourselves a little bit of setback here, Mike.
All right. What do you want to dive into a little bit deeper after all that, Luke, for some talking points?
Yeah, so this is an outstanding opportunity to review position. Basis is now right. Actually, basis is a little better than normal. So, we've been kind of dragging our feet a little bit because basis has been wide. So get your April position, short up. Summers, if there's any repositioning you can do, if you've got some calls you can buy back, take a look at that. And we've had, I think 12-month margin has dropped here below 30 because corn and meal have cut against us and hogs have dropped right. But, just keep working the plan and keep pushing it further out. I can't say I chased a lot of new sales after this sell-off here yesterday and today, but sold right up into it. So still all in all, hog complex is in a good spot. It's just March. It's just a little bit slow. And I do want to jump into the beef just a little bit. Beef choice is still really hot, and there's a lot of things going on that I'm sure what you guys have talked about in your beef podcast, right? But my point is, beef choice box beef is busted up around or a little better than $400. But the point is not so much its absolute value, but it did break the seasonal trend. It's moved up quicker than normal. Both choice box beef and pork cutout will rally in the spring and summer, right? This one rallied early, so
Yep.
again, it's good opportunity to get rid of decayed calls, make sure your position's right. Feels like they've beat this up maybe plenty, but it's also real hard to get. Maybe a guy can get a little friendly from $91 where we closed or around today here, but it's going to take some push to race past 95 and higher. That's a little bit harder to see here. And 18 days, 17 days after day, not a lot of time left on that contract.
Are you worried about commodity super cycle, fund massive buying? What impact do you think that has on the hog market specifically before we get into commodities?
Well, actually,
broadly?
that you perfect. I wish I could have said I coached you on. That's the perfect segue of where I want to go to my next discussion.
Perfect.
So commodity cycle. I mean, the proteins are still in a great spot. We still have low beef supplies. We have high cutout. Hog supplies. We're producing plenty of pork, right? But demand's good. Same thing in cattle. Same thing in hogs. Corn today is relatively cheap. Meat's price make them big, be top of your grid, right? So, the hog industry itself, it's still in some pretty solid footing. It's just we've been trading really, really high prices. So, I think that the meat side, the revenue side, we will see what the hog and pig report says next week. But, to me, it's stable-ish type of breeding herd. We may be adding a few here and there, right? But supplies, that's all in a good spot. Demand's in a good spot. What we're probably most concerned about, and this resonates probably maybe a little bit better with some of our Eastern Corn Belt customers that are fighting a positive corn basis, right? But here in the West, we still have a lot of corn. We've got a negative basis around. But let's just take a step back. And our biggest concern right now on the livestock side is margin base and its inputs, Mike, just simply put, okay? And so I'll put a little bit of backdrop. I don't have a chart up, didn't ask Cade to get a chart, but 2023 was really rough in the hog industry. It wasn't because meat price was so horrible, it's because corn was so expensive. It's $6, $7 corn. You had $100 cost of production. It's really hard to make money with high price corn in the hog complex, in protein complex in general, right? And so generally speaking, and we saw like as our margins cut week to week, yeah, we lost some revenue, but we had higher corn. What could kind of mess this thing up? It's a little longer term out, is we get into a much higher cost scenario on our inputs, corn and meal. And so I'm going to dive into the Iran conflict. And we, now what are we, you told me this morning, how many days into this are we?
Just about 2 weeks.
2 weeks, 14 days in.
Yeah, I mean, it was February 28th.
And
a little bit more now.
When Trump started this, I mean, he wanted to neutralize the Iranian nuclear threat, right? And I think that's pretty well been achieved, or at least a long ways towards it, right?
It's delayed their capabilities of a nuclear activity
at the minimum, right? And then a regime change. I think that was in the wish list, right?
Yeah.
The question is, how much resolve will we have towards? I think the Israelis want the regime change really, really bad.
I think they're the ones driving that,
and they're continuing to pound, right? But as this thing, I mean, it's. What the mark is today is to us it escalated this week as we started attacking both us and Israel, some natural gas, some petro plants, some different type of infrastructure, right?
Yes.
And that has a longer reach. And then I want to just put in perspective, we've increased oil capacity tremendously in the U.S. In fact, Kate, if you've got that chart handy, we are the world's largest producer of oil now, Mike, right? That's the right stat?
Correct, 22%. We'd be about double anyone else. Iran is fifth on that list. And just on the impact of trade alone, the Strait of Hormuz kind of being the chokehold point, Iran is still holding on us. 38% of the oil that goes through the Strait of Hormuz goes to China. However, all the other oil that goes through there also goes to other Asian countries, Luke. So the leverage we have over China specifically right now is great. But over the past, I'd say 24 hours, 48 hours, a lot of the headlines have revolved around Iran's intensified attacks on oil and natural gas facilities all around the Gulf, the last couple days, and that's really raised the stakes on things because of that key infrastructure taking some pretty massive hits lately. So we're not just at a point where we're kind of on a chokehold at the Strait of Hormuz. Now we do have damaged facilities that will have long-term impacts on the industry. So Brent to the WTI, pretty massive spread now between the two, which would be U.S. oil basically versus the rest of the world. The rest of the world's getting pretty expensive compared to the U.S. because we really don't have a problem here. We're a net exporter. It just depends on what oil's worth for the rest of the world compared to us, really, Luke, at the end of the day. So capabilities of commodity supercycle, yes, but it revolves heavily on the backs of this Iran conflict, continued intensity, and major geopolitical disruption and infrastructure through the Middle East for the energy space particularly.
Yeah, absolutely. So thank you for that. And where I was, just wanted to put some perspective is we're not short on oil domestically here in the States, right? We're seeing gas and diesel prices go up. Diesel's $5 at the pump, right? But we can purchase it, right? It's just, it's getting more expensive. Other spots around the world that are more dependent on this Iranian or Middle Eastern oil, like we heard stories just like Australia, for example, like they're running out of gas, like lines at the pumps, they're running out of diesel more specifically, right? So you've got that.
They import everything.
You've got that broader effect in other countries that are more susceptible. It's a bigger effect, right? And so how that boils in, when we take a look at energy, if we put the crude to corn chart up, I mean, there's a very strong correlation where oil goes, corn goes, right? Obviously, corn to ethanol, that's it's got a few limitations at the pump, supply chain, and this.
But they just like to buy it for a fund money flow, inflation hedge in general, anyways.
Absolutely, but it correlates, and quite frankly, more now than ever. I mean, because above $80 crude, like soy oil flows right into diesel.
Yep.
And there's no limitations. You can have a high diesel soy oil blend, right?
California's proved it.
Yep. California's proved it. So, and then you've got, we're going to have next week, or not next week, two Tuesdays with the 31st planning intentions report and the whole big debate. I mean, are we 94? Are we 92? Or, where is all that at? But, the increase in fertilizer cost because of the Iranian conflict, I mean, it doesn't help gain more acres, right? And then, we haven't had a drought situation in the past, 2 or 3 years in either North or South America, and long range forecasts. And I always get a little bit, what's the right word? Skeptic. The weather is hard to predict, but it's a dry spring. That's good for planting. What's that? Planting the dustbins will bust. Is that the saying, right?
That would be.
And then good rain through the summer and into the fall, right? So it's not like looking droughty on the forecasting, right? But, if this oil runs, this conflict moves, and we run into higher feed costs, because big picture, I mean, $4-5 corn, that's still in the reasonable corn. That's it's still kind of cheap corn, right?
Yeah. And even like meal was up $9 yesterday at a $12 trading range. So you're seeing some really big volatility there. Something a lot of folks really weren't worried about either was meal prices going higher.
Absolutely. So you talk, what are we worried about? How do I sum it up? It's just, as we crush pigs and we cover pigs, we need to be at minimum synced up on the crush side, on the corn and meal side. We do tend to like a little more options out I'm talking new crop, right?
Yeah.
On the corn, we don't mind some flat price on the meal by any stretch of means. But it went from, especially talking to some of our Western Corn Belt end users where we still are chucked with old crop, right?
Yep.
We need to really look at this. And what's one of the biggest threats to our business is if this inputs get away from us, it's hard to get meat prices high enough to offset that. So, we're absolutely suggesting if you're a little behind, maybe get a little caught up, maybe a little ahead.
Time to start running some what if strategies on the
Absolutely.
inputs.
Let's not get complacent on the wheel, because that again, and hopefully this all gets done and behind us, and and we can move past it. But there's some of these things, once you set these wheels in motion, they don't turn on a dime. So I guess that's the biggest thing that I think's changed week to week. And again, it felt like with the infrastructure, the longer term, the thing did escalate to a point that it's a little harder to turn this back quicker, right, Mike?
For sure. All right. Any other final thoughts for our listeners today?
Well, I think the last one, I may get myself in a little trouble with this, but here in about 20 minutes, Iowa State's got a little basketball game there. So go Cyclones.
And go Jackrabbits. We play here at 1:30 this afternoon. We'll see if we can make past the first round of the dance.
All right. Thanks, sir.